We're navigating markets in a moment where speed and uncertainty exist side by side. The ship is still sailing, but the lights on the dashboard are flickering. The government shutdown continues with no end in sight, and that means something markets do not like: less information. Economic releases, labor reports, spending figures, certain inflation components are all delayed or incomplete. The Fed, investors, and analysts are sailing through macro waters without functioning radar. Stars obscured, GPS intermittent, the horizon is blurred. We are still moving forward though, but it is getting harder to trust the instruments. Even with limited data, one signal stands out. Job openings have cooled to roughly 7.2 million, the weakest reading since early 2021. For every unemployed American, there is now just under one job opening, a ratio that had been comfortably above one for years. And early signs point to younger workers feeling it first. Slower early career hiring, fewer entry-level postings, and a tighter funnel for graduates. The labor market isn't rolling over, but the glide path isn't as clean. Meanwhile, major employers continue to reduce headcount. Names like Amazon, UPS, and Target have all announced significant corporate job cuts. A subtle tightening of sail as companies brace for slower winds and embrace new technology. Now, layer in the Fed. Despite political pressure, policymakers cut rates 25 basis points, signaling support for growth as uncertainty builds. But here's the kicker. Inflation just ticked back above 3% for the first time since March. Shelter remains sticky, energy popped, and tariff plus supply chain pressure keeps costs simmering. Rate cuts into rising inflation with limited data is like adjusting course on a ship when the compass might be off by a few degrees. A small error today can be compound over distance. And yet, market continues to power higher. Risk appetite remains firm, confidence is intact, momentum is real. Under the surface, leadership has been decisive in large cap space, where tech is north of 30% year to date, followed by communication services and utilities. Here, not a single S&P large cap sector is negative this year. The rally is firm, but like good pasta, it is al dente. Strong enough to hold shape, but soften it with a little macro heat, and the texture could change quickly. In small caps, the contrast is sharper. Small cap tech leads at 21% for the year, while small cap consumer staples and energy still sit at double-digit negative territory. And this divergence has consequences. Tech now is roughly 35% of the S&P 500, concentrated largely in the top 10 names. The market isn't just rising, it is rising on narrow, powerful leadership. As earnings data come in, the tech big players are announcing double-digit revenue growth, but at a cost. CapEx, AI build-outs, and tax complexities remind us even the leaders feel the strain of this environment. A shutdown limiting visibility, a cooling labor market around the edges, corporate belt tightening, a Fed easing into rewarming inflation, markets at record heights, fueled by concentrated tech strength. The ship is still moving, and moving quickly, but the fog is thick, the radar is patchy, and most of the way is on one side of the deck. In moments like this, discipline matters more than forecasts. Balance matters more than bravado. And capital preservation is not the enemy of growth. It is the engine that lets you stay full invested through uncertainty. I'm Tammy Beck. This is FinTalk. Stay focused, stay informed, and I'll see you next time.